Let's get to Jason Van Cleef, who is CEO of Van Cleef Financial Group in Los Angeles. He's also the author of The Wealth Code, How the Rich Stay Rich in Good Times and Bad. Staying in Singapore this morning, John Bollinger, founder of BollingerBands.com. Jason, isn't this the title of your book? Isn't this the key issue that many people have with Goldman Sachs, that it managed to short many of its trades and protect its wealth during good times and bad?
Well, it's definitely, what I've always talked about with the keys of wealth is using lots of ideas, lots of things. And, of course, with Goldman Sachs, it's, looking at the bigger picture. I mean, they designed kind of a casino game that, according to the SEC, their heart of their claim is that they rigged the game, so to speak. So it's, to me, the idea of the wealthy protecting themselves has been more so of using different asset classes and many concepts, not necessarily just stocks and bonds.
Jason, Bernie in Hong Kong, John Bollinger, who's our guest host this hour, has expressed the concern that for now the GOP has scuttled the regulatory reform process and they're going to have to go back to the floor and back to square one. But what are the chances they're going to over-regulate and really put paid to this whole industry and change the whole tone of how we do things? And what would that impart onto the markets?
Well, I definitely see. I mean, today we saw the markets. I mean, obviously people were nervous about the bank regulations and so forth. Of course, the flip side is there might be the old buy the rumor, sell the facts. So right now we could be seeing a little bit of the, bring down the banking stocks, bring down Goldman Sachs a bit, and then once they actually pass some regulation, whoosh, everyone will sigh a breath of relief of air and then bring them back up. Kind of like we saw in the healthcare stocks. I mean, once the regulation was passed, people said, oh, okay, and then they started bringing up the healthcare stocks. So,
Jason, how real are the worst-case scenarios that some of the critics of regulation have been painting? On the one hand, if the regulators are going to zero in on derivatives trading, that's a large portion of their profits. Is it going to hurt earnings significantly? And the second issue is, are we going to see a migration of business from those developed markets, from the US and North America, over here to Asia, where perhaps the rules are more slack?
Ultimately, I mean, the derivative markets, I mean, we see this with, for instance, even Buffett. I mean, everyone was trying to get their own little, exclusions into the bills that are happening right now. And a lot of groups have these derivatives that they have naked derivatives. They had no collateral in the game. That's one of the hot buttons that is part of this financial reform bill. They're also saying we need to put up a lot more collateral. They need to have a marketplace to create a transparency with this. The other issue they were talking about was, you can create the deals, but you can't sell the deals. I will say in that case, I'm a little concerned about, because a lot of the profits do come from, obviously selling off the products and doing that type of issues. If, a problem with basically taking away being able to sell is you actually take a lot of liquidity out of the marketplaces. So in terms of earnings, I think it's very real to suspect that it could bring down the stocks in terms of potentials in the future.
Jason, I understand that you have a fairly bearish outlook on the U.S. stock market. I'm wondering what sorts of news items you think might drive a decline past the 2009 lows.
Ultimately, you can even look at things like the Case-Shiller Index. I mean, right now it stands at about 22. We've only been at that kind of lofty valuations 5 times going back to 1880. And what is happened once we've gone to these kind of levels is it didn't really bode well for the markets in the future. For instance, being at this 22 level typically suggests a 1 to 2% outlook for the next 10 years or so. Not that, it's basically saying buying right now, potentially you're buying at a valuation that's very rich. We've been guiding clients over the last few months to say, it's time to take a breather. We've just basically seen one of the largest rallies in history, even going back to a comparable rally that we saw in January of 1930 to June of 1930. And unfortunately, what happened after that rally was an 86% correction in stock markets. So we've told clients it's time to take a breather right now. Enjoy the fact that the stock market gods have given us this kind of rise in the marketplace, but maybe we kind of lick our wounds a little bit, take a breather, and kind of evaluate from the sidelines.
Okay. Okay, Jason, on that cautionary note, we must say goodbye to you and thank you. Jason Van Cleef, CEO of Van Cleef Financial Group.